Welcome to Stock Spotlight. I'm Michael, your guide to the stock market. In each episode, we analyze companies that have earned a watch or pass rating on my 33-question checklist. Today, we're shining the spotlight on the trade desk, ticker symbol TTD, and uncovering what makes it a potential new investment opportunity. Join me as we explore the insights and strategies that empower savvy investors like you to make informed decisions. Let's dive in. My 33-question checklist evaluates companies across 9 categories, which helps me gain a holistic understanding of the business. So far, I've screened 219 stocks across 9 sectors and 68 industries with a mean quality score of 59% and a top quartile benchmark of 70%. For the trade desk, I scored them in April 2025. And data used for this episode is as of Q1 25. Now, they scored an 81% quality score, which is in the 91st overall percentile and 78th in their sector. And this is good enough for a pass. Let's now discuss the trade desk business. So their business falls within the advertising industry in the larger communication services sector. As of July 14th, when I started writing the script for this episode, their market cap was $37 billion, but it's now jumped up to $41 billion on July 15th after they were announced to be in the S&P 500. All right, so let's talk a little bit about how the trade desk evolved. The trade desk was founded in 2009 by Jeff Green, a pioneer in ad tech who previously sold his first startup, which was one of the first demand-side platforms, to Microsoft. With the trade desk, Green has set out to bring transparency, control, and measurable performance to the emerging world of programmatic advertising. This is what helps marketers buy digital media more efficiently and intelligently through automation. Key milestones that I've listed for the company include 2010 to 2013, there was an early traction in desktop display advertising as digital budgets began shifting toward real-time bidding. And then in 2014 to 2016, they expanded into mobile, video, and connected TV, or CTV. And then in 2016, they also went public on the NASDAQ. And then in 2018 to 2020, they had international expansion and the launch of Edge Academy, which is their training platform to onboard marketers into programmatic media. And then I have a 2021 now to present period where they've rolled out Kakai, a major AI-driven platform upgrade that supposedly enhances prediction, bidding, and measurement across channels. They've also spearheaded Unified ID 2.0, which is an industry-wide cookieless identity framework designed to preserve addressability and privacy on the open internet. Now, here's one interesting investor insight. Nearly all of their growth has been organic, and they've deliberately avoided M&A or walled garden models, instead positioning themselves as a neutral infrastructure layer for the open internet. Now, what do they sell? The trade desk operates a cloud-based demand-side platform, which I will now just call DSPs, that empowers advertisers to plan, buy, and optimize digital ad campaigns in real time. Its core capabilities include omnichannel buying across display, video, mobile, audio, and connected TV, real-time bidding and cross-device measurement to reach the right audience at the right time, data integration and AI-powered optimization using first-party data and identity solutions like that Unified ID 2.0, full transparency, or at least more transparency, into campaign performance across publishers, devices, and formats, which is something that's not really offered by walled gardens like Meta or Amazon. So unlike platforms that monetize media inventory, TTD doesn't sell ads. They sell the tools to buy smarter ads, giving marketers more control and better measurement across the open internet. Now, who do they sell to? So they are a B2B platform primarily serving global brands like think of Procter & Gamble or L'Oreal. Also advertising agencies who are running campaigns for multiple clients using TTD as their central hub for programmatic buying. And then also retail media networks, but more indirectly as they help power their programmatic infrastructure or partner on data collaboration, like think Target and Home Depot. So TTD's supply-side collaborations enhance the value of their DSP by bringing better data, more exclusive inventory, and deeper measurement, while still keeping them neutral and open compared to walled gardens. It's a quiet way they're expanding their moat, So retail media network partnerships is an area to be mindful of as an investor. While the trade desk benefits from high volume relationships with major ad holding companies, it does maintain a broad and diversified base of advertisers. In fact, according to the 2024 10K, one advertising holding company aggregating spend across multiple agencies and clients accounted for more than 10% of gross billings in each of the past 2 years. That signals some concentration at the channel level, but when you break it down by advertiser vertical, the picture is much more balanced, with the top 3 verticals making up around 40% of total spend. And the top 3 are food and drink, which is around 18% of total spend, and it's been a leading vertical for the last few years. And then number 2, automotive at 12%, and then number 3 at medical and health, and then number 3, medical and health at around 11%, and then other verticals are in that single digit range. So while a few large agencies drive significant media volume through the platform, the underlying base of brands is well diversified, reducing dependence on any single client or sector. This structure also reflects the nature of programmatic, where the trade desk real exposure is to broad advertising trends, not individual logos. In terms of revenue generation, the trade desk runs a transaction-based, usage-driven business model centered around its cloud-based self-service DSP. Revenue is primarily earned through a platform fee, which is generally charged as a percentage of a client's total media spend flowing through the platform. This includes not just ad inventory, but also value-added services like data integrations, measurement tools, and AI-powered optimization. The model is highly scalable. As clients run increasingly complex multi-channel campaigns, the trade desk doesn't need to add headcount at the same rate. Most customers sign MSAs that provide open access to the platform, but do not guarantee any minimum spend, so revenue is fully performance-linked. When it comes to reporting revenue, the trade desk applies a key accounting judgment. Are we the platform facilitating the transaction, or are we the primary provider of the service? If TTD is acting more like a connector or broker, for example, when clients use third-party ad inventory or data, they report only the platform fee as revenue. This is known as net revenue reporting. If TTD controls and delivers the service directly, such as bundling their own tools or data with inventory, they may report the full transaction value as gross revenue. In most cases, they use net revenue, which reflects their role as a facilitator of programmatic transactions, more so than an ad seller. Looking at revenue drivers, there's a few key factors influencing revenue growth that I think an investor should know about. First, CTV adoption. As linear TV declines, more ad budgets are shifting to connected TV, which remains their fastest growing channel. Second, AI optimization, specifically around Kokai, and these drive improved outcomes and higher ROI, increasing client retention and wallet share. Speaking of which, number 3, client retention. Revenue growth depends on both retaining existing clients and expanding their spend on the platform. And fourth, international expansion. More client spend coming from global regions, especially Europe and Asia, is a way that they can continue growing well into the future. Next, I'd like to analyze their pricing power. So I've rated the trade desk as moderate to strong pricing power. I do think they enjoy a favorable pricing position. Supported by several durable factors. And the 2 main ones that I'll talk about is stable take rates. Despite ongoing scrutiny of ad tech fees, they've maintained a consistent take rate in the 19 to 21% range since 2017, and coming in at 20.3% in 2024. CEO Jeff Green originally guided to a 15 to 20% range post-IPO, and the company has delivered on that target. For context, other platforms like Airbnb are around 12 to 14%, and Mercado Libre Commerce are around 18 to 24%, and so they reflect a similar or slightly lower level of take. And then also switching costs. Once agencies and brands upload proprietary data, build custom integrations, and train teams on the platform, they face significant friction to switch, which I think boosts retention and pricing power over time. Next, let's look at their price elasticity among customers, which I've rated as moderately inelastic. The trade desk platform fee is typically a small line item relative to the broader media budget. It helps optimize. Because it boosts efficiency, attribution, and ROI, I believe clients are less price sensitive, seeing it as an enabler of returns, not just a cost. However, I do want to note ad spend is cyclical. While TTD's pricing holds firm, overall spending flow through the platform can still dip during economic downturns. Let's now take a look at their business segments and geographies. The trade desk operates as a single segment company, with no internal segmentation by product line or vertical. All financial results are reported at the consolidated level. Despite being a global platform, the Trade Desk remains heavily US-centric in terms of gross billing. Their 2024 10K lists two geographies, though: the United States at $10.24 billion, which was 87% of total, and plus 25% year over year, and actually plus 53% year over 2 years. And then also international at $1.5 billion, which was 13% of total, plus 24% year over year, and plus 61% year over 2 years. While 87% of their spend in 2024 was from North America, 60% of total global ad spend happens internationally, and this is per IDC. That gap signifies a long growth runway for TTD. Morningstar assigns a narrow moat rating to the Trade Desk, supported by two sources. The first, switching cost. They note that their self-service DSP is deeply integrated into advertiser and agency workflows, and their 95% plus client retention for over a decade is strong evidence of platform stickiness. Their second source of this narrow moat rating is intangible assets. This moat source is derived from their proprietary technology that creates algorithmic pricing models to allow the advertiser to decide what's most important and how to act. Morningstar also notes early signs of a network effect around Unified ID 2.0, as growing adoption across the ad tech ecosystem enhances targeting performance. They don't get a wide moat rating because the broader ad tech landscape is fast-moving and crowded, with no platform immune to disruption. Every great company reinvests in itself, but not all R&D spending is created equal. I break it down into three key areas. First, how much a company spends in absolute dollars compared to peers. The Trade Desk has steadily scaled R&D from just $13 million in 2015 to $463 million in 2024, with trailing 12-month spend now at $488 million. That puts them in the same league as AppLovin, which was $606 million trailing 12-month, and far above Programmatic at $34 million. I then like to look at R&D as a percentage of revenue to ask, are they investing heavily or just maintaining? Over the past 3 years, TTD has spent around 20% of revenue in R&D, consistently above peers AppLovin at 17% and Programmatic at 10%. The third thing I then ask is how efficiently do they turn that R&D into growth? And I've created this new metric called R&D efficiency ratio. Efficiency has trended lower as TTD has scaled, but they do remain competitive still. Their 1.51 3-year average R&D efficiency ratio is below AppLovin's 1.96 and Programmatic's 2.05, but really a ratio greater than 1 is what we're looking for, as it means that the Trade Desk is generating more revenue growth than it's spending on R&D. Overall, it appears that the Trade Desk R&D machine is built for long-term defensibility. A strong company is only part of the equation. You also need a great industry. So let's take a closer look at the landscape the Trade Desk operates in. First, I'd like to give an overall rating of their industry attractiveness. I give the programmatic advertising industry an attractive rating. The digital advertising industry, particularly the programmatic open internet segment where the Trade Desk operates, is structurally attractive. It benefits from secular tailwinds like the ongoing shift of ad dollars from linear to digital, especially into CTV, retail, and audio. There's a growing push from regulators and brands for transparency, which strengthens the position of independent platforms like the Trade Desk. And while competition remains fierce, especially from vertically integrated giants like Google and Amazon, the Trade Desk neutral role in the ad ecosystem gives it flexibility to partner across publishers and brands. Advertising is also cyclical, but as Joel LaRue pointed out on X, it's a great industry because companies will always want to grow over the long term. And one of the best ways to do that is to spend on advertising. In terms of their competitive environment, the Trade Desk operates in a highly competitive digital advertising ecosystem. Its main rivals fall into 3 categories. The first, independent DSPs. The Trade Desk competes with a range of smaller independent DSPs like StackAdapt and the now acquired Amobi. However, most lack the scale, channel breadth, and technological sophistication of the Trade Desk. They may perform well in specific niches, but often fall short in areas like connected TV, global reach, or real-time optimization. There's then also walled gardens. These are the big tech giants that operate massive closed advertising ecosystems known as walled gardens. So these competitors include Google, Amazon, and Meta. Google's DV360 controls YouTube inventory, giving it unmatched scale, but restricting access for independent platforms like TTD. Amazon's DSP is tightly integrated with its retail data and is expanding rapidly into connected TV, though it still keeps everything within its own closed loop. Meta's ad manager dominates in mobile and social formats, but like the others, it limits cross-channel measurement and transparency. While these platforms make it easy for advertisers to run campaigns within a single ecosystem, they limit data portability, customization, and third-party oversight. The last bucket is hybrids, SSPs, and other. This third group includes companies that don't fit cleanly into the DSP or walled garden boxes. These players often serve the supply-side publishers, or SSPs, or focus on mobile and in-app monetization. A few examples here are AppLovin, which is a vertically integrated mobile ad platform, best known in the gaming world. It operates both supply and demand tools, but focuses on performance-driven in-app ads, not open internet brand campaigns. There's also Magnite. It's one of the largest SSPs in the world and is an increasingly formidable CTV-focused alternative. They're building toward a more unified omni-channel video stack that includes measurement and planning features, traditionally DSP territory. Shout out to @BagHolderIQ and InvestYoda77 on X for highlighting Magnite's growing role as a trade desk alternative. Looking at Reddit sentiment for the trade desk, they generally get high marks for their CTV offering and seamless platform integrations, but some users do flag a recurring theme around a steep learning curve, lack of YouTube inventory, and perceived client service erosion as they scale. There's also some concern around take rates or hidden fees. Overall, though, sentiment is cautiously positive from those users who understand its strategic value. As we know in this podcast, I then like to look at comparably to compare some customer metrics. When it comes to customer loyalty and NPS, the trade desk shows solid results, but not quite best in class. The competitive set for this analysis included Meta, Google, AppLovin, Magnite, and Pubmatic. The trade desk 70% loyalty score is below the peer average of 77%, and only Magnite is lower. With that said, they do shine on NPS, scoring a 32, which is well above the 18-point average, and second only to Google at 42. Magnite is the worst performer of the group, with a loyalty score of just 69% and a negative NPS of -20. After looking at customer metrics, I then like to pull up Fiscal AI for a financial metrics comparison, and I pulled 5-year averages and forward estimates to benchmark the trade desk financial profile. The trade desk continues to shine on gross margin at around 81% and free cash flow margin at 28%, which is right alongside Meta. While it doesn't dominate on free cash flow per share or per employee like AppLovin or Alphabet, its 22% forward free cash flow CAGR shows that investors are paying up. Its 22.3% forward free cash flow CAGR matches its valuation, which is among the highest in the group. Magnite and Alphabet have the most interesting valuation of this group. Look to X for the full tweet. Look at the industry size and growth forecast. The global digital advertising market is enormous, but the definition of addressable market varies. Morningstar estimates the total digital advertising TAM at around $700 billion in 2024, while the trade desk, citing Magna 2024 data, has the market TAM at around $935 million, with approximately $135 million representing the core programmatic advertising TAM, which is video, audio, display, and DOOH. Now, as of Q1 25, the trade desk reported $2.6 billion in trailing 12-month revenue. Using the $135 billion open internet TAM, that implies a revenue-based market share of around 1.93%. Other third-party estimates vary. 6sense.com pegs TTD share at 2.73%, while CSI Market provides a more conservative estimate of 0.21%, likely due to broader market definitions. Within DSPs, some sources estimate the trade desk market share even higher at 20% plus. Either way, despite this strength, walled gardens continue to dominate the broader digital ad landscape, In 2022, Statista reported that 78% of global digital ad revenue went to walled gardens, with projections rising to 83% by 2027. That leaves just 17% of global digital ad spend on the open web, the very segment the Trade Desk serves. The Trade Desk is projected to grow revenue from $2.4 billion in 2024 to $5.5 billion by 2029, reflecting an 18% CAGR, based on consensus estimates from over 30 analysts via investorsgrow.com. This outpaces most industry projections, suggesting analysts expect continued market share gains. Now, industry growth estimates do vary. From what I've gathered, forecasts are split into global and the US market. For global CAGR, most forecasts like Mordor Intelligence and Statista suggest global pragmatic advertising will grow around 10 to 12%. And then in the US market, reports from Grand View Research suggest 22%, and Business Research Company suggests 21%, showing faster growth in the US, which is the Trade Desk largest market. Next, let's review the Trade Desk's quality growth profile to see if they are appealing quantitatively. First section is predictability, and there are 2 questions. Is 5-year trailing revenue stability greater than or equal to 0.84, which is my weighted portfolio average? This is a revenue consistency metric that incorporates both trend and volatility. The answer to this question is yes. As of fiscal 24, Trade Desk's 5-year trailing revenue stability is 0.86, which does meet my portfolio benchmark. The next question is 10-year SBC adjusted free cash flow linearity greater than or equal to 0.77, which is also my weighted portfolio average. In this case, the answer is no, as their linearity is just 0.12, which does suggest more volatility and less consistency year over year for the time period. There is also 3 years of negative SBC adjusted free cash flow, so it's a little messy here for the Trade Desk. The next section, profitability, there are 2 questions. Is 10-year average gross margin greater than or equal to 40%? Yes, it is 79.5%, which is also greater than my portfolio weighted average of 63.6%. The gross margin standard deviation is also lower than my portfolio weighted average at 2.1% versus my portfolio at 3.4%, indicating tremendous consistency here for the Trade Desk. And then the second question is 10-year average SBC adjusted free cash flow margin greater than or equal to 15%? No, it is 0.6%, which is well below my benchmark and weighted portfolio average of 21.8%. The last 2 years are 3.1% and 6%, so there are some signs of improvement here, but standard deviation was also high at 19%. So this metric failed. We'll then move on to growth and conversion. Is 10-year revenue CAGR greater than or equal to 5%? A 5% revenue CAGR is fine for long-term compounders, so that's my minimum benchmark. So for the Trade Desk, the answer is yes, they grew at 49.3%. Incredible. The second question is 10-year free cash flow per share CAGR greater than or equal to 10%? So if I want revenue CAGR at least 5%, then I want free cash flow per share at least double digits. For the Trade Desk, this is a yes, as they had a CAGR of 17.3%. And I did have to use an 8-year time period since free cash flow per share was negative from 2014 to 15. The last question in this section is 10-year average free cash flow conversion at least 75%. For the Trade Desk, this is another yes, as theirs averaged 231%, although it does come with high volatility, a 250% standard deviation, and a lower 10-year median at around 164%. But either way, they pass and quite impressive. So then we have 2 questions for value creation. Is 10-year average combined ROIC, and that's just combined between stock analysis and quick FS, at least 20%, and ideally greater than the 2024 NYU database industry average? For the Trade Desk, this gets a no, as their combined ROIC was 16%. I also ran an adjusted ROIC that you'll see posted on X, because traditional ROIC doesn't tell the full story, as the Trade Desk holds a lot of excess cash and runs a capital-light business. But this adjusted ROIC actually came out to the same 16%, so it's still below the 20% benchmark that I have, and the industry average, which is a very high 35%. The second question is combined ROIC trending up if low, or holding steady if already high? I'm leaning no on this, as both combined ROIC and adjusted ROIC are still well below prior highs and have downward trends over the past decade. With that said, ROIC has rebounded for 2 straight years, but I'd want at least 1 more year of sustained gains to confirm the trend. Looking at the full picture, the trade desk passed on 5 of 9 questions, or around 55%. We'll now dive into a high-level overview of the trade desk's 3 financial statements. First, the income statement. I've already talked a little bit about revenue, so let's just go straight into margins. They consistently deliver best-in-class gross margins of 80% plus, underscoring the scalability and efficiency of this cloud-based model. However, their GAAP operating and net margins remain lower due to aggressive reinvestment and high stock-based compensation. I then like to look at a company's COGS. While many financial sites include platform operations under COGS, the trade desk actually classifies this as an operating expense on their 10K. Either way, this line item encompasses hosting infrastructure, data acquisition, client support, and amortization of platform development. These costs rise as usage grows, but even with that, gross margins stay strong. Their operating costs are well distributed across 3 categories: sales and marketing, which averaged around 28% of gross profit from 2020 to 2024. This reflects strong ongoing spend to drive that customer acquisition and brand partnerships. There's then G&A, which has seen the most volatility over the last 5 years, and it's ranged from 26 to 40% of gross profits. This covers executive, legal, HR, and compliance, and includes CEO stock comp, which is a swing factor in this line item's volatility. Lastly, they have technology and development, which has hovered between 23 and 26% of gross profits. The last thing I like to look at in the income statement is just checking out their interest coverage ratio. The trade desk boasts an exceptional 10-year average interest coverage ratio of 92, with recent years far exceeding both the Benjamin Graham benchmark of 5 and my ideal threshold of 10. In 2024, they posted an eye-popping 283x ratio, a clear sign of minimal debt and robust earnings. Next, let's talk about the balance sheet. We'll first go into their top assets. The first thing worth noting is that the trade desk has no goodwill on the balance sheet, which is a rare sign of balance sheet cleanliness and well below their 2024 industry average of 30%. Their top asset is accounts receivable, which consistently makes up 55 to around 75% of total assets, and then also cash and short-term investments, and they've steadily increased, which reflects that growing financial flexibility. Looking at liabilities, the trade desk has no traditional debt, and its liabilities are dominated by accounts payable, which makes up a consistent 83% plus of total liabilities. Long-term operating lease liabilities remain a manageable 7 to around 15% of total liabilities, while accrued expenses are modest and in line with historical levels. So there's 3 financial stability ratios that I like to look at on the balance sheet, and overall, they demonstrate excellent financial stability. So their debt to equity ratio, which measures capital structure, has had a 10-year average of 0.24, which is right below the current industry median of 0.26 and well below my 1.50 threshold. For cash to debt, this is what measures liquidity, and the trade desk scores very well here again with a 10-year average of 3.94, which far exceeds my benchmark of 0.75 and the industry median of 0.54. I then like to look at debt to free cash flow to measure debt paydown ability, and the trade desk exhibits strong debt coverage again with a 10-year average ratio of 1.26, well below my threshold of 3. Turning to the cash flow statement, since 2020, the trade desk has consistently generated strong cash flow from operations. The main source of inflows is customer payments tied to accounts receivable turnover. Overall, it's a high conversion business with minimal reliance on financing or non-core activities. On this statement, I like to look at 2 different types of intensity: stock-based compensation intensity and capital intensity. The first question I like to ask is SBC less than 10% of revenue and reasonable versus peers? For the trade desk, this actually gets a no, as their SBC percentage has consistently exceeded both the NYU database industry average of 3% and my 10-year threshold of 10%, as theirs peaked at 32% in 2022 and is now settled at 20% in 2024. As a percentage of operating cash flow, SBC has averaged a 10-year median of 68%. For capital intensity, I like to ask, is CapEx less than 4% of revenue, which is around the S&P 500 average, and reasonable versus peers? Their 10-year median CapEx is 4.3% of revenue, right at my portfolio benchmark and well above the NYU database industry average of 0.7%. While capital intensity has fluctuated, it's been under 4% in 5 of the past 10 years, suggesting relatively modest investment needs for a software-based business. Now let's talk about who's actually steering the ship at the trade desk, and whether their incentives line up with long-term shareholders. First, leadership. So the trade desk has a founder-led and owner-operator model. Jeff Green's dual role as founder and major shareholder provides long-term alignment with investors. He isn't just the CEO, he is the trade desk. Jeff co-founded the company in 2009 and has served as CEO for over 15 years, which is more than 3x the US average for public company CEOs. He also owns around 9% of total shares and controls around 49% of the voting power thanks to Class B supervoting stock. While not a technical majority, this level of control gives him de facto command of corporate direction. Founder-led businesses with meaningful ownership stakes often outperform over time. Green's voting control below 50% technically preserves some governance checks, but practically he holds all the cards. This is great if you trust him and risky if you don't. Looking at employee reviews, their internal culture appears strong based on Glassdoor. 82% of employees would recommend the company to a friend, which met my top quartile database average. 89% approve of Jeff Green's leadership, and 87% have a positive business outlook. So looking at their comp goals and some ownership requirements, total direct compensation targets the 75th percentile versus peer roles. The CEO is required to own 6 times his base salary, and executives must own 1 times their base salary, and equity vest over 4 years, which is designed to retain and reward longer-term loyalty. There's also this 2021 mega grant for Jeff Green that's worth discussing for a minute. In 2021, he received a performance-based stock option for up to 16 million shares with a $68 strike price. Vesting only occurs if the stock price hits targets between $90 and $340, and TTD outperforms a NASDAQ 100 on total return. So far, 2 tranches have vested, and the full payout, potentially worth billions, only happens if the stock continues compounding. So investors should be aware of potential dilution. If all 16 million shares vest, I have this representing around a 3% increase in share count. In terms of his compensation breakdown in 2024, he was paid $1.2 million base salary and had a $5.2 million cash bonus, which was tied directly to revenue targets. No new equity grants, but the board does expect to resume annual grants in 2025, and all for a total comp of $6.8 million, which is significantly lower than 2023's $32 million, but the difference there is that option vesting from the mega grant. While tying the $5.2 million cash bonus to revenue creates clear line of cycles, to me this does feel a bit generous, especially since it's not tied to margins or free cash flow, which I think are a little bit more difficult to achieve. Turning our attention to capital allocation, Morningstar gives the trade desk a standard rating, noting that its strategy of prioritizing reinvestment, especially in R&D and platform enhancements, aligns well with a high-growth business model. And as we know now on this podcast, I do like to quantitatively measure acquisition intensity, which is just acquisitions percentage of operating cash flow. And for the trade desk, as Morningstar notes, it is very low, averaging 1.3% over the last 10 years. Now, looking at their 10-year median total shareholder distribution, which is buybacks plus dividends divided by free cash flow, we want this below 100% over the long term. And the trade desk 10-year median distribution is just 13% of free cash flow, which is right in line with high growth tech norms and well below my 100% cap. Despite a couple of outsized buyback years like 131% in 2023 and 58% in 2024, I like to wrap up this section with looking at shares outstanding, insider buying, selling, and ownership structure. So I first like to ask, is diluted shares outstanding declining or at least holding steady over the last decade? And for the trade desk, while shares are up 283% over the last 10 years post-IPO, they are up just 5% over the last 5 years and have remained virtually flat since 2021. So this tells you that buybacks are being used to offset some of that dilution. Using investorsgrow.com, the trade desk has seen significantly more insider buying than selling over the past 12 months, with 1.8 million shares bought versus 554,000 sold. But upon further analysis, these transactions appear more administrative than conviction buys. Then looking at ownership structure, I like to see high insider ownership with a benchmark of at least 10% and institutional ownership with a benchmark of at least 75%. And the trade desk is right at that first benchmark with insider ownership at 9.3%, and same with institutional ownership at 72%. So both are slightly below my benchmarks, but still strong overall. Let's now dive into a few key metrics that are critical to monitor for the trade desk. The first thing I'd measure is revenue growth versus industry. The trade desk 18% expected CAGR likely reflects its focus on high growth segments like CTV, retail media, and data-driven open internet, and suggests it's going to grow faster than the global market, but not necessarily the US subsegment. Tracking revenue growth relative to the industry will help an investor assess whether they are gaining share or simply rising with the tide. The second KPI I would take a look at is take rate stability. TTD earns a platform fee, typically around 20% of spend, and this take rate has held remarkably steady between 19 and 21% since 2017. A stable or rising take rate signals pricing power and sustained value delivery to clients. Let's wrap up with valuation and technicals. Note, my valuation of the trade desk was done the morning before the S&P 500 inclusion news broke, and this sent the stock up 13 to 14%, so just take that in mind as we go through this section. Now, for valuation, I use a hybrid approach here. I believe multiples capture market sentiment, while intrinsic methods anchor my longer-term view. Given the trade desk's growth profile and improving free cash flow stability, their 5-year trailing stability ratio is 0.76, I leaned on 3 free cash flow-based valuation methods for that cash flow focus, and then added an EV to EBIT plus R&D multiple to adjust for their high reinvestment in R&D. For a DCF, I used investorsgrow.com, and they have 50 plus analysts' free cash flow estimates for the trade desk over the next 5 years, and the model assumed a 9% discount rate and a 2.5% terminal growth rate, followed by another 5 years of gradually declining growth, rather than dropping straight to that 2.5%, since their last forecast still shows 20% free cash flow growth. Based on all that, their fair value comes out to around $62 per share, which is 18% below the current price of $75. That implies a forward IRR of roughly 7 to 8%. I then did a reverse DCF on my own spreadsheet, and what I like about this method is that it flips the script on a traditional DCF. Instead of saying what TTD should be worth, it tells us what growth rate today's $76 price already bakes in. So if you plug in a 25x terminal price to free cash flow multiple, you get an implied 15% annual free cash flow growth rate over the next decade. Based on the free cash flow estimates from Investors Grow, TTD looks set to clip along at a roughly 22% rate for the first 5 years. The real debate is what years 6 to 10 bring, especially with north of 70% of the valuation here living in the terminal value. I then looked at an SBC adjusted free cash flow yield from Stock Analysis and Investors Grow. This ties valuation directly to the company's ability to generate cash, and I believe it's a strong alternative to the price to earnings ratio. So stock-based comp has consistently dragged down their free cash flow, resulting in ultra-low SBC adjusted free cash flow yields, often under 1%. And so this method is going to be weighed a lot less for me than others, but for fun, I looked at a non-adjusted free cash flow yield, and if we apply a trailing 12-month non-adjusted free cash flow yield of 1.95% to today's enterprise value, we get an implied share price of $74. Lastly, I looked at an EV to EBIT plus R&D multiple through my own spreadsheet. This valuation framework treats R&D as a long-term investment, which makes it especially useful for capital-light, innovation-heavy firms like the trade desk. On a trailing basis, TTD trades at a 30x multiple compared to 17x for Programmatic and 39x for AppLovin. Historically, TTD has actually traded at a median multiple of 51x, which reflects those high growth years. Now, if we apply that multiple to today's trailing EBIT plus R&D, we get an implied share price of $98, which is about 30% above the current price. But what if that multiple compresses? Given TTD's forecasted free cash flow growth of 18 to 20%, still strong but slower than those hypergrowth days, I ran a sensitivity check. Applying a more moderate 35x multiple, the implied stock price drops to $68. So valuation depends heavily on your conviction and the trade desk's ability to maintain their premium status. Traditional DCF has them as slightly overvalued, while reverse DCF has the market pricing in about 15% free cash flow per share growth over the next 10 years. If you believe in a return to historical multiples, like their EV to EBIT plus R&D median of 51x, the current price looks cheap. But if we normalize for slowing growth and apply more conservative multiples, the implied valuation sits at slightly overvalued. Looking at some trend analysis, on the daily 1-year chart, TTD is in a short-term uptrend. It recently reclaimed its 20, 50, and 100-day EMAs and is now consolidating just beneath the 200-day EMA, which is currently at around $82. A bullish crossover has occurred between the 20-day and 50-day EMAs, which can often precede momentum continuation. However, upside progress may stall around the 81 to 83 range, which has acted as a volume shelf and support resistance over the past year. Now, looking at the weekly 5-year chart, the long-term trend remains neutral to down. TTD is trying to get above the 200-week EMA at around $76, which has acted as strong resistance. The long-term 50-week and 100-week EMAs are still above current price, indicating that the stock is probably in an early stage 1 basing phase. Looking at some volume analysis, the anchored volume profile in both the 1-year and 5-year charts highlights the $73 to $77 range as a high volume node, suggesting that this area is a key battleground between bulls and bears. If TTD can hold above 74, it builds a case for accumulation and future breakout. As of mid-July 25, short interest stands at 5% of float, which is right at that bullish threshold of technically less than 5% for me, and it's much lower than in years past. All right, so now let's talk about my verdict. I'm projecting a 5-year total shareholder return for TTD of around 20% per year, broken down as 22% free cash flow per share, and this is using analyst estimates from Investors Grow and a 0.5% net buyback rate, a minus 2% valuation multiple change, and this is using EV to EBIT plus R&D, and a 0% dividend. The trade desk clears my TSR hurdle with a projected 20% return, but quality, valuation, and technicals still matter. While it scores an 81% quality score on my checklist, its quality growth metrics discussed on this podcast are mixed. Valuation models suggest fair value closer to $60 to $70, and technicals point to the current price as a battleground. The bull case leans on 20% plus free cash flow growth, CTV tailwinds, and a founder-led model. The bear case highlights margin volatility, international execution risk, and competitive pressure from walled gardens. For now, it's a watchlist name for me, and I'd become more interested if it dips into the low 60s. And that wraps up today's episode of Stock Spotlight. I hope you found my analysis of the trade desk both insightful and actionable. If you enjoyed today's episode, please subscribe, leave a rating, drop a comment, or take the episode poll. For real-time updates and insights, follow me on X at invest091. Join me next when we'll take a detour from our usual deep dives to discuss an important topic, factor investing. Until then, keep your investments smart.